Hey all, welcome to your tutorial on doing a transaction analysis sheet for accounting. As you're going to find, this is a pretty cumbersome thing that we're going to do, but it's going to help us understand the interactions between the various accounts that we have in accounting. So this will align with the previous file that you're going to have in D2L. And I just want to show you how to do one of these. So we've talked a little bit about balance sheets, a little bit about accounts. The accounts you see here are ones you will typically see. So under my assets, you see we have cash, accounts receivable, supplies, building. Under our liabilities, we've got an accounts payable, bank loan, a mortgage, and then under owner's equity, we have something called capital. We haven't really built on these concepts too much, so let me talk for just a minute about some really important ones. Under assets, you will see accounts receivable. That is money that is owed to us from our customers, and they will usually pay that off fairly quickly. So it could be a bill at the end of the month that they haven't paid us, and we know we have money coming in. Flip over to liabilities. Accounts payable is the same thing, except we owe money to our suppliers. So we got a bill and we have yet to pay it. So it's an accounts payable, and we'll likely pay that in the coming weeks, and that'll be off of our books. Finally, the big one, and the biggest area where students get confused, as I outlined in the balance sheet tutorial, is under owner's equity. You'll see we have only one account called R. Gregg Capital. This is a really important account. That is where we are going to put our stake in the business, or how much we invested in purchasing our assets. So if I were to do a quick piece of math, which I won't do for this tutorial, and I added up my cash to my building, it would equal the value of my total liabilities and my capital account. Because there's only two ways to buy things. Either you borrow money or you use your own money. And that's what a balance sheet does. Okay, so let's get into how to use a transaction analysis sheet. As you would have seen in your note for transactions, when we have something happen in the business, there are at least two accounts that are impacted. As an example, if I take out a $10,000 bank loan, I'm going to have more bank loan, so I would have another $10,000 under bank loan. I also have cash. That's what happens when you get out of bank loan, is they give you $10,000 cash. So on the opposite side of my equation, my cash has gone up 10,000. So my assets have gone up 10,000 under cash. My liabilities have gone up 10,000 under bank loan, and my left side assets still equals my right side liabilities and owner's equity. A very common transaction you're going to see is owner invested money in the business, or owner withdrew money from the business. Right now, we'll just look at an investment. So if the owner puts in $5,000, there's $5,000 more in the business, so that would go under cash. And then also, the capital for the owner would go up $5,000 because they've invested more money in the business. So for a transaction analysis sheet, what we're doing is we're tracking the various things that have happened in our business in terms of transactions, and we are increasing or decreasing our accounts accordingly. So I'm going to take you through this example. You then have an example that you can do on your own. Once we're done this, we're going to build a new balance sheet. So below here, I've got my instructions, and these instructions say record the above transactions in the analysis sheet. Once done, click on the balance sheet, which is going to be here. Right now, it's just a blank. And update our balance sheet based on the new transactions we've done. So let's get into it. So transaction number one, the owner invested $1,000 in the business. So anytime the owner invests money, I'm going to get more cash. Typically, you're going to see cash as one of your accounts that will be affected, but owner invested money in the business, so I get $1,000 more cash, and the owner's investment has increased by $1,000. So what I do is I go up to my analysis sheet, which I'm going to freeze now. I've already put the dates in, but my cash goes up 1,000, and then my capital goes up 1,000 as well. So that's it. So that is transaction one done. After I've done that, I want to carry my balances down. And a little bit of spreadsheet math for you. It's very simple to do. If you go with the equal sign, click on your original balance, and then click plus, and click on the below balance. My update is $11,000. The reason I want to do that formula is, let's say I made a mistake and that should have been $2,000. You'll see my 12,000 automatically updated. So let's go back to that 1,000. And then there's a really easy way to carry all of our balances over. So I don't have to do all of these. And I do want to carry down even the balances that I didn't use. So to do that, I'm going to click on this, and you'll see there's a little blue button here. Once I do that, my arrow is going to turn into a black cross. There we go. I'm going to click and drag that across, and I'm basically telling my computer, just add those two columns as I did before. So I still have 2,000, 1,000, 50, etc. And then my capital, I had 20. The owner invested another 1,000. So I now have 21,000 bucks. So beauty, I am done that. Let's go on to our next transaction. I made a $600 payment on the company mortgage. All right, so if I make a payment, I know that I have $600 less, so minus $600 for my cash. And then I also owe less mortgage because I paid it off. So I'm going to go over to my mortgage, minus 600. And then once again, I'm going to carry down my balance. I'm going to still add this together because it's a negative. So I now have 10,400. I'm going to do my drag thing across. And my balances have been updated. I'm going to go to June 3rd. Oh, I missed one. Okay, customer paid $500 on their account. All right. Once again, as I've said to you earlier, we are humans and we make mistakes. So you get a preview of the next one. But customer paid $500 on their account. So they owed us money. That's where it is. This is a tricky one, but this is what we want to think of. If they pay us money, we have more money. But we are owed less money. So we get more money, but the customers now owe us less money, and that was for $500, correct? Okay. So one thing I guarantee my friends is I will make a mistake on virtually every video that I do, but I don't shoot them because, as I said earlier, I don't reshoot them because I'm human. And I want you to be human when you're doing these things as well. Okay, so we already did this one. I know I've got $600 less in cash, and then $600 less in my mortgage. I'll do these balances. I'm going to carry that across. All right, and then one last one. We obtain a new bank loan for $4,500. So when we get a bank loan, it means we have more bank loan. So I'm asking myself, am I getting more, less of something? What's going on? Does it actually affect the account? So I know now I'm getting more bank loan. And when I get a bank loan, I also get more cash. So I got more cash through the bank. All right, and then I'm going to do my balances once again. I know I'm going through this pretty quickly, but the beauty of the video is you can pause and rewind it as you will. And instead of shooting a 4-hour video, I can get this wrapped up in a few minutes. Alrighty, my friends, so there it is. I've got my balances here, and if I look, 1, 2, 3, 4, 5, I did it again. Can you believe it? And it's not even Friday. All right, so actually, I paid a supplier $100. Holy moly. Okay, so if I pay a supplier, then I paid the money. It's going to be 100. You can tell your family, my accounting teacher really is not good at proofreading. Okay, so if I paid a supplier, means I have $100 less because I paid that money off. And then under my accounts payable, which is where my bills for my suppliers are that I haven't paid yet, I owe $100 less now. So there's not as much owing. So it should be $2,900. I'm going to do my balances. I'm going to carry that across. All right. And then June 5th, by the way, that's my birthday, but on June the 5th, hopefully you're not taking this class because that means you would have failed this one. Okay, obtained a new bank loan, $4,500. All right, Mr. Truhaus, do this right. And then I got $4,500 more in bank loan. And by the way, if things don't balance out for me, then I'm going to quit my job. All right, so here's what I want to do now. I want to say, what is the balance of my total assets? I'm going to do a little math here just to check it. So to do this, I'm going to go, I showed you in the first video, you can use that sum button, or you can just type this out, equals sum bracket, and then highlight my balances. Close the bracket. You can rewind that if you didn't get that. Okay, so 67.8. If I did this right, my accounts payable, bank loan, mortgage, and capital will balance out to 67.8 as well. Alrighty, now we're in business. Okay, so these are my updated balances here, right here. And that's what I'm going to do my balance sheet on. So I've done all of my questions. I missed a few, had to delete and redo them, but that's okay. That's why I get paid the big dollars to shoot these high quality videos for you, my wonderful students who I won't meet, except for the ones that I teach in person, at which point you probably think I'm being completely ridiculous. Okay, so let's do our balance sheet now. I've completed this, I've got my balances, all's good. It's a beautiful day. Now, I've memorized a few of these, but I got cash, accounts receivable, supplies, building. So I'm just going to do this. Under my assets, I'm going to go cash, accounts receivable, supplies, building. Beautiful. Under my liabilities, I've got a payable, bank loan, and a mortgage. And then I know my owner's equity is Greg, comma. So first initial, last name, comma, capital. All right, so I've got my structure in. Now I want to use my updated numbers. I'm not using these numbers because that's old. That no longer applies to the business. I'm using these. So my cash is 15.3. And I've pre-done the formatting. You can watch the first balance sheet for dollar signs and underlines and all that stuff. Then I got 15 and 1,000, 1,500, $1,000. And my building is worth 50 grand. Okay. It's a little bit of clicking back and forth, but not a big deal. 2,900 and then 16.5. 2,900, 16,500. Our mortgage is 27.4. If any parents are watching this, I'm sure you would all love to have a mortgage of $27,400. Okay, and then my capital is $21,000. All right, now let's do this. Here I should have total liabilities. Here I'm going to have total assets, and this will be total liabilities and owner's equity. Okay, so I'm going to do the sum function again. Again, you can click that button that was in the first tutorial. I'm not repeating the first tutorial over again, so you can watch that. I'm going to highlight my numbers, close the box. 67,800, which is what I had in my first page, which is wonderful. I want to add up all of my liabilities. So that plus that should equal this. So my total liabilities plus my capital should equal 67,800. Excellent. And now I'm going to do my underlines. And then I'm going to do my double underlines. Again, this is in the first tutorial. Watch it if you don't know what I'm doing. And there you go. So I've updated my balance sheet based on my transactions that I did. You can see it's incredibly cumbersome and time consuming. So the reason we use transaction analysis sheets for basically a week in this course is to get you used to doing transactions back and forth and seeing how everything's interrelated. After that, we're going to come up with an easier way to do this. So you'll have a chance to practice this. We'll do an assessment on this where there's going to be some marks, and that's going to be it. So watch this video, pause the video, rewind the video, fast forward through the parts where I did the wrong thing. We're good to go. All right, kids, talk to you soon. I'm out of here.